The corporate earnings for the second quarter are almost over, and probably I think most of the companies failed to deliver their results. A lot of expectations were laid out from a lot of companies across sectors, but what really happened within the banking space is a very clear evidence that the credit recovery and the corporate recovery in terms of earnings is still some time away. The mid-cap PSU banks exhibited weak set of numbers across, and probably the asset quality has not yet roughed out. So one really needs to wait out for the economic recovery process to see, indicate and show probably whether the cycle has probably turned for the better. Similarly, I think if you look at the private space, I think they performed a little bit better than the public counterparts. But again, I think one really needs to be stock specific. So we do like financials like Axis Bank, ICICI Bank, HDFC Bank, where we believe I think the valuation gap between them and the public sectors would stay. When it comes to capital goods, I think the whole story again is on similar lines. I think bereft of orders, probably later half of Q2 you saw some orders passing through for bail. L&T managed to get orders, but again I think execution, working capital cycle probably needs to turn for the better for the overall industry to probably show signs of recovery. So in that sense itself, I think L&T would probably still remain a preferred pick within the capital goods stroke infrastructure space. When it comes to the other sectors, specifically the export-oriented sector, IT and pharma, I think the rupee probably held in resilience to the earnings that they probably indicated. Infosys showed a great set of numbers, and so did HCL Tech. But however, I think the market expectations are a little bit too high for IT companies. And when it comes to pharma again, I think the expectations were high. So I think Cipla did disappoint in terms of expectations of the market, and so did Sun Pharma. And clearly again, the valuations are working against them. So I think Dr. Reddy still remains one of our preferred picks there. And within the IT space, I think the top tier names like an Infosys and an HCL Tech, in our opinion, would still deliver earnings growth. I think the EPS would still be 235 rupees for EPS in FY16, probably for HCL Tech at 110, and even in the valuation perspective, trades much cheaper than what an TCS does. So probably I think the earnings season has been a mixed bag, but clearly I think one really needs to be stock specific. If you talk about the markets overall, our take is that in terms of valuations, specifically when you compare that against the other emerging market space, at 16 times forward, you're fairly valued from an FY16 perspective. But with a lot of expectations probably laid out in the winter policy, the winter session of Parliament, and probably the budget in February, that would be key deciding factors and triggers for the market going forward. Again, I think with credit growth coming back, with economic cycle coming back, and the capex cycle turning, probably next year's earnings should see resilient growth. Our expectations, again, I think solely lies on the fact of all these factors working together for a 16-17% earnings growth over the next couple of years, which can probably get expanded to 18-20% as well. In that scenario, I think applying a forward ratio, I think we still remain optimistic and bullish upon the markets. What sectors probably you can look at, probably is infrastructure, you can look at the road sector, the logistics sector, which has performed exceedingly well in the recent past, and probably financials along with autos can be expected to do well. Select cement companies delivered probably realizations held up and benign raw material costs. I think some of the companies did exhibit good set of numbers. JK Lakshmi Cement, Mangalam Cement, India Cement, the regional player still remains a preferred pick because on an EV to ton basis, they still trade at a relatively higher discount compared to their peers. So our take is that one really needs to be stock specific as we have been retailing week after week. And probably within stocks that we like this week, I think Everest Industries is something that we are recommending. The asbestos steel maker would probably, I think, show good set of numbers in FY16, FY17. The prefabricated steel building division should probably exhibit greater ROCs going forward. In the similar breath, I think something like an NCC, Nagarjuna Construction, is also expected to do well. I think with the rights issue, the debt should come down from 2,600 odd crores to 2,000 odd crores, pulling down interest costs substantially. Even from a valuation perspective, the EBITDA margin should expand to 8%. EPS can be grown from 3 rupees to 5 rupees. At forward earnings of 18, I think the stock can reach levels of 90. So be stock specific. I think be light-footed into the market. Probably wait for opportunity, wait for declines. But clearly, I think the markets are here to stay in the range. Probably 8,000, 8,050 on the lower end, 8,550, 8,600 on the higher side. Happy investing and probably have a great year ahead.